Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, March 5, 2015, daily chart of the SPY. We had a pretty mundane day in the S&P or across all the major markets today. And one of the main reasons was because we have that elusive monthly Non Farm Payroll report that's due out at, I believe it's 8:30 in the morning on Friday. And as a result of that, the day before, we normally get some kind of a pause day. The market's kind of waiting around to see what the number is and which way it should go and all that stuff. It's all nonsense. The number's made up to begin with. The market's going to whip around for about 5 or 10 minutes around the number in the pre-market. You know, the E-mini and the S&P futures contracts, that'll whip around a little bit, and then it'll find a direction, and whatever direction it finds, it'll be because of the jobs number or the employment report, and that's the end of it. And then usually we'll go into somewhat of a lighter volume Friday kind of float around if we have one of those normal Fridays. If it's some outlier and we have something else unfolding, well, that is what it is. But normally, under normal conditions, we would see maybe a little action in the morning on Friday, and then usually it kind of goes to sleep and floats around for the rest of the day. We finish higher into the weekend and then come back next week to fight another week. So that's kind of what I see unfolding for tomorrow. Don't have a definitive direction. It's going to be a big day one way or the other. I just think that we've hit a short-term cycle bottom, so I'm expecting a few days of upside. So what I thought was interesting, let's backtrack to intraday today, because if you remember last night, I said that we had a full moon upon us, and I might have even said that the full moon was yesterday, but it actually hit today. What happened to my symbol here? Bear with me. Okay, we're back on the chart. So the actual full moon, believe it or not, hit today at, I believe it was 1:05 p.m., 1:05 this afternoon. Now watch this. Here we are. Okay, this is the beginning of today, okay? Let's go to 9:30, okay? Right here, here's today. We go up, we go down, we go back up. Now the market tries to sell off a little bit, and we make a low. And let's look at what time we made a low. 1,300 hours. Translated into real time, that's 1 o'clock in the afternoon. So 1 o'clock in the afternoon, the market, coinciding with the full moon, takes off to the upside. Now, remember yesterday I said the full moon has a tendency to turn markets, and a lot of times it has a tendency to turn precious metals, and we'll talk about gold when we get there. But it actually turned the stock market. Well, the stock market turned coinciding with the full moon. You believe what you want to believe. I'm just facilitating the information. There's no secrets in this world. There's just stuff we don't know. And a long time ago, I learned that full moons and eclipses have a tendency to mark turns, albeit short-term and minor turns in the market, but turns nonetheless. And so it's just something that I like to pay attention to. I don't necessarily put a trade on as a result of it. I just like to pay attention to it, know it's there, and I'm more intrigued by it than anything else. So thought it was worth mentioning. So anyway, so that's what we have. So I think that we're in the midst of a maybe a 2, 3, 4 day bounce in the market starting from yesterday's lows, okay? And then I think we could see a little bit more downside testing, because I still think we're in a weekly pullback or a weekly cycle top that has taken hold. But, depending on where we close the week, that may or may not be of importance by next week. So we'll take it one day at a time. So let's go back to a daily chart and I'll show you what I'm talking about. Okay, so if we were to close by chance, right? If we were to close the week tomorrow over 212.24, okay, that's just a bullish sign all out. And then we go up and we test in the S&P E-mini, we test 2023-24, and then we continue up 2035, and then we evaluate from that point. And all in all, there are higher prices ahead, but we still could see some more downward pressure. We're going to have to take it one day at a time and then see what happens. But remember, when we look at a monthly chart, okay, we had a breakout in February, okay? We had a closing high breakout in February, and to me, in my work, that's meaningful, and that tells me there's higher prices ahead. Okay, let's move on, and let's talk about the gold market, since we already mentioned it, and let's go back to a daily chart, and basically, the gold market struggled today, and we did not close on the above the lower end of our range at 1,200. We closed underneath that by $3 or so, and I'm not going to make a big federal case out of that. All I'm going to say is I'm not enamored by gold. However, I do think that we still should see some bullish upward momentum develop shortly, and as long as we stay above this low here, okay, down here at 1189 or 1190, as long as we stay above the 1190 number, we're still going to be in a bullish position. But the closer we get down to that, the more concerned I will become. However, where's the downside if we do break the lows? You could go all the way down to 1168. That's a possibility. This pivot low here, that is certainly possible. Where's the upside? The upside is 1223, and then 1228 and 1235. That's the upside targets that we would have if we should get some upward momentum picking up. So that's where we stand. We're kind of in no man's land, but I still think gold remains in a bullish position, so I'm looking for upward momentum to begin anytime soon. Okay, let's go over to the oil market. Interesting day in the oil market. So quick recap. This week, there was a possibility that if the oil market closed above $51 a barrel, that we would go all the way up to 53.5, and then possibly a round trip or back down to 50.25, 50.5. Well, as the week went on, I said that the odds of that total round trip playing out were diminishing because we were running out of time. But let's look at what happened today. So let's look at the hourly chart, okay? And I was actually watching this overnight and then early in the wee hours in the morning. Yep, that's exciting to me, folks, believe it or not. But anyway, so here's what we have. So if you go back to yesterday, okay, we sold off. We came down to and tested the 49.70, that elusive 49.70. And then we shot higher, okay, and then we went sideways through the morning hours, and then we shot higher early morning today, okay, up to making a high of 52.40. 52.40, and then we reversed, and we made a new low intraday at 50.61, 50.61, 50.61. So we just missed the upside target, but the whole scenario actually did play out the way I was mapping it out, right? We closed above 51. The market immediately took off to the upside. We went, higher. We just didn't make it to 53.5 because time was running out, but we got to 52.40, and then we reversed all the way back down to 50.62, and I was saying back down to 50.25 to 50.50. Well, I'm okay with missing it by 12 cents on the upside or the downside, but nevertheless, that was the oil trade, and that trade's pretty much in my mind complete. So we'll just look for what's developing in the next day or so and see if we can come up with a new scenario in the oil market. Make mention of this. Some of the markets are easier to trade than others. So oil from time to time gets easier to trade, easier to read than the S&P, for example. Gold from time to time is easier to read than the S&P. There are other markets. Sometimes the bond market is easier to read than the S&P. So that's why I talk about a wide array of different markets, because you don't have to just trade one thing. In fact, the majority of my portfolio is made up of individual equities, individual stocks, ETFs, and they're rotating in and out any given time. I don't really care what it is. I just care what the chart setup is. And if the chart setup is there, I put the trade on and I hit my targets and I get out. And that's basically the way I manage the portfolio. And, I just thought I'd make mention of that for those that are interested. So, okay, so we talked about oil, we talked about gold, we talked about the stock market. Let's talk about the bond market. Not much going on here. We're still in a position where I believe that there's a strong possibility that these lows are going to hold. But it's not strong enough to say, we're going up tomorrow through next Wednesday. I don't have that type of conviction. If I had to put a number on it, I'd say I'm kind of in the 60, 65, 40, 35 camp in terms of this holding. But if it doesn't hold, where my lower number is. It's 124.25 on the extreme downside, and we may not even get there. So either way, I think there's bullish tendency ahead in the bond market, at least for the short term, for a trade, if nonetheless. But while we're here, let's go and look at the long-term bond market chart, because I want you to understand something here. This parabolic move on a monthly basis, okay, dating back starting from January, the end of January, or January of 2014. Okay, so basically for a year, okay, the last month was January 2015. So for a full year, the bond market goes parabolic, interest rates go straight down. All right. Now, then you have a reversal month in February, and what this is telling me is that prices want to go lower in the bond market over time. Nothing goes in a straight line, so don't misunderstand the fact that I'm bullish for the short term, the bond market. But long term, I'm bearish, meaning I think by this time next year, you're going to see the TLT at minimum of down in this area here, okay, down in maybe the 110, 112 area, right in this neighborhood, if not worse, okay? And what I'm saying is throughout the remainder of 2015, I'm expecting overall lower bond prices, higher yields, higher interest rates, higher borrowing costs, higher car loan costs, higher mortgages, higher credit cards, higher cost of money, which normally slows the economy. But the whole point is cyclically, we're really in a bullish part of the year for the stock market. So, I don't want you to put the cart before the horse. I'm just trying to give you the bigger picture of what might be unfolding throughout 2015. So if I had to map out a forecast, I want to take these things into account when I'm doing my cycle work, I'm doing my analysis, and all the pieces to the puzzle that get put together to give us the actual forecast and allow us to buy positions and take advantage of which direction the market's going, up or down. I don't really care which way it goes either way. All I care about is making money, whether it's on the upside or the downside, and whatever the market is doesn't matter to me. So for that, I think we're going to leave it there. Hopefully this has been helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.